Welcome the Islamic Finance Unboxed channel. Today we will zoom out a little bit, and we will think out of the box. Why do we say Islamic finance, but not Christian finance or Jewish finance? It's a curious paradox. All three Abrahamic faiths have deep moral and legal teachings on money, interest, and fairness. Yet only Islam has built a modern global financial system branded with its religious identity. Today, Islamic finance manages over $3 trillion in assets across banks, Sukuk, and investment funds. Meanwhile, Christian-majority countries shaped global capitalism, and Jewish communities played pivotal roles in finance. Yet neither resulted in a distinct, institutional category called Christian or Jewish finance. So why did Islamic finance emerge as a recognized label? And is this branding helping or limiting its growth? Shared roots, religion, and money. To understand the paradox, we need to go back in history. Judaism, the Hebrew Bible, contained strict prohibitions on charging interest to fellow Jews, though loans to outsiders were often treated differently. Over centuries, Jewish communities developed strong ethical frameworks for trade and contracts, but finance was never codified as a standalone Jewish financial system. Christianity. Early Christianity also condemned usury. The Church reinforced bans on interest during the Middle Ages. But as European economies expanded, workarounds appeared. Merchant banking in Italy, credit instruments in Northern Europe, and eventually, Protestant interpretations that softened the stance on interest. This evolution allowed Christian societies to lead the financial revolution of modern capitalism. Islam. Like Judaism and Christianity, Islam forbids riba, often interpreted as interest. But Islam went further, embedding broader principles of fairness, risk-sharing, and wealth circulation through zakat, waqf, and trade ethics. These were not just moral guidelines, but core pillars of economic life. In short, all three faiths started from a similar place, but their trajectories diverged. Why Islamic finance became a label. The story of Islamic finance as a formal identity is tied to modern history. 1. Colonial disruption. Many Muslim-majority countries fell under European colonial rule. Western banking models dominated, and traditional Islamic economic practices declined. After independence in the mid-20th century, Muslim leaders and scholars began asking, can we build financial systems rooted in our own values, rather than simply copying the West? 2. Institutionalization. The 1970s saw the birth of the Islamic Development Bank, the first Islamic banks in Egypt and the Gulf, and the codification of standards like al-Wafa, accounting and auditing organization for Islamic financial institutions. This gave Islamic finance an institutional home, something Christianity and Judaism never created. 3. Consumer demand. Millions of Muslims wanted banking services that aligned with their faith. Unlike Christians or Jews, who had already integrated into secular financial systems, Muslim populations in newly independent nations sought a clear alternative. 4. Oil wealth. The oil boom of the 1970s provided both the capital and the confidence for Gulf states to invest in financial models branded as Islamic. Together, these forces created not just a practice, but a market identity, Islamic finance. Why we don't say Christian finance or Jewish finance? Now let's flip the question. Why did other traditions not create parallel categories? 1. Integration into capitalism. Christian-majority countries, especially in Europe and North America, became the architects of modern finance. Instead of creating Christian finance, they reshaped global capitalism itself. The ethical debates on usury were absorbed into secular laws, banking regulations, and eventually ideas like corporate social responsibility. 2. Jewish experience. Jewish communities had significant influence in finance, particularly in medieval Europe, but this was never branded as a religious financial system. Instead, contributions were absorbed into mainstream finance, from merchant banking to Wall Street. 3. Secularization. Both Jewish and Christian societies secularized their financial ethics over time. Concepts once tied to religion evolved into general principles. Fairness in contracts, protection against predatory lending, and social responsibility. They became universalized rather than religion-specific. Islam, in contrast, kept the label. Why? Because it revived finance at a time when religious identity was central to politics, society, and post-colonial nation building. The advantages of the label. So is the label Islamic finance a strength? In many ways, yes. Visibility. The brand gave Muslims confidence that their money could circulate without violating faith. Growth. It attracted both Islamic investors and non-Muslim governments, like the UK or Hong Kong, which issued Sukuk bonds. Differentiation. By naming itself, Islamic finance carved out a niche in a crowded global market, now worth trillions. Without the label, Islamic finance might have disappeared into the margins. The risks of the label. But labels also come with risks. Perceived exclusivity. The term Islamic can make it sound like a system only for Muslims, even though non-Muslims use it. Fragmentation. Some argue that tying finance to religion risks isolating Muslim economies rather than integrating them. Branding over substance. Critics say that many so-called Islamic financial products look almost identical to conventional ones, just rebranded with Sharia-compliant structures. This raises a sharp question. Is Islamic finance building a truly different system, or simply wrapping conventional finance in new packaging? Universal future? Looking ahead, the debate intensifies. Should Islamic finance remain a religiously branded system, or evolve into a universal framework of ethical finance? On one hand, the label provides trust and identity for Muslims. On the other hand, Islamic finance principles, risk-sharing, avoiding exploitation, linking money to real assets, are not exclusively Islamic. They are ethical values anyone can adopt. This is why we see non-Muslim nations experimenting with Islamic financial instruments. Sukuk, for example, are attractive to global investors because they are asset-backed, not because they are religious. Perhaps in the future, Islamic finance will merge into something broader, a global movement of value-based finance where labels fade, but principles remain. An open question. So, why do we say Islamic finance, but not Christian finance or Jewish finance? Because Islam institutionalized its financial ethics at a time when religious identity was central, while Christianity and Judaism secularized theirs into mainstream capitalism. The label gave Islamic finance power, visibility, and a clear identity. But it also raises difficult questions. Does the label empower Islamic finance, or does it hold it back from becoming universal? And maybe the bigger question is this. Do we really need religious categories of finance at all? Or are we heading toward a future where finance is simply ethical, fair, and sustainable for everyone? Please subscribe and like for upcoming insights.